2,000 years before J.P. Morgan, a Roman banker standing in the Forum could transfer money across the empire without moving a single coin.
When we think of banking, we imagine marble skyscrapers, digital transfers, and central banks controlling global economies. But the foundations of modern finance were laid not in London or New York. They were built in ancient Rome. In this video, you're going to discover who the argentarii were and how they became Rome's financial elite, how Romans created deposits, loans, and even early checks, why the Temple of Saturn functioned like a central bank, and how reckless monetary policy helped crash the Roman economy, just like modern financial crises. By the end, you'll see that Rome didn't just conquer the world with legions, it conquered it with ledgers. If you enjoy deep dives into the hidden systems behind ancient empires, make sure you subscribe. We post weekly videos uncovering the secrets history forgot. Now, let's step into the Roman Forum. In the heart of Rome, near the temple of Castor and Pollux, beneath towering marble columns and surrounded by shouting merchants, sat the argentarii. The word comes from argentum, silver. Originally, they were money changers. Remember, the Roman Empire stretched from Britain to Egypt. That meant hundreds of different local currencies were circulating in markets. A merchant from Greece might arrive with drachmas, a trader from Gaul with Celtic coins, a tax collector with Roman denarii. The argentarii made trade possible by exchanging currencies and taking a fee. But they didn't stop there. Over time, they evolved into full-service bankers. They held deposits, issued loans, financed trade expeditions, even handled auctions.
Yes, Roman bankers operated at public auctions, recording bids and extending instant credit to buyers. They kept detailed written accounts in books called codices. And here's the key. Roman banking wasn't a fringe activity. It was legally recognized, regulated, and woven into the economic fabric of the empire. The argentarii weren't shady moneylenders and back alleys. They were respected professionals operating in the open air of the Forum, where everyone could see them. Some became incredibly wealthy. By the 1st century AD, banking families were financing senators, landowners, and even imperial projects. In other words, Rome didn't just have bankers, it had a banking system.
Let's talk mechanics. How did Roman banking actually work? First, deposits. A Roman citizen could deposit money with an argentarius for safekeeping. There were two types: depositum, where the banker simply guarded your money; mutuum, where the banker could use your funds but owed you repayment. Sound familiar? That's fractional reserve banking in its early form. Instead of coins sitting untouched in a vault, bankers could lend deposited money to others, earning interest in the process. Now, here's the shocking part. Romans had cashless transfers. If Marcus owed 1,000 denarii to Lucius, he didn't need to carry sacks of silver across the city. He could instruct his banker to transfer the amount in his ledger. The banker would simply debit Marcus's account and credit Lucius's. No coins moved, just ink on parchment. This system was called perscriptio, essentially an early bank transfer. They even had something similar to checks. Written payment orders could be presented and settled through the banker's records. Now, let's talk interest. Under Roman law, the standard legal interest rate was 12% per year. That's 1% per month, known as uncia centesima. Legal interest rate, 12% per year. However, rates varied depending on risk. High-risk maritime loans could charge far more, because if the ship sank, the lender lost everything. This was known as foenus nauticum, maritime interest. In some cases, rates exceeded 20% or even 30%. Risk-based lending, collateralized loans, written contracts,
credit networks across continents. This wasn't primitive finance. This was sophisticated economic engineering, and it allowed Rome's economy to scale to unprecedented size.
Now let's zoom out. Private bankers operated in the Forum, but who controlled the empire's money supply? Enter the Temple of Saturn. Built in the 5th century BC, it housed the Aerarium, Rome's state treasury. This is where tax revenues were stored, war spoils, tribute from provinces, emergency reserves. Gold and silver bullion were kept here under guard. The Senate oversaw the treasury, and officials called quaestors managed its accounts. In many ways, this functioned like a central bank. It didn't just store money, it stabilized the financial system. During crises, the state could inject funds into the economy. In 33 AD, a severe credit crunch hit Rome. Loans were being called in. Property values collapsed. Liquidity vanished. Sound familiar? Emperor Tiberius intervened. He released 100 million sesterces into the banking system as interest-free loans to stabilize credit markets. That's quantitative easing. In the 1st century, the Roman state understood that financial panic could destabilize the entire empire. But this power came with risk, because whoever controls the treasury controls the currency. Rome's financial system was advanced, but it wasn't invincible. Political interference repeatedly destabilized banking. In 342 BC, the Lex Genutia attempted to ban interest altogether. The idea was populist: protect citizens from debt. The result? Credit markets froze. When lenders can't charge interest, they stop lending. The law was widely ignored or repealed, but it revealed a dangerous tension between politics and finance. Fast forward to the 3rd century AD. Rome was in crisis. Civil wars, invasions, plague. Emperors needed money, fast. So instead of raising taxes directly, they debased the currency. The silver denarius, once nearly pure silver, was gradually diluted. By the time of Emperor Gallienus in the 260s AD, the silver content had dropped to less than 5%. Imagine your savings losing 95% of their intrinsic value. Inflation exploded. Prices soared. Trust collapsed. Then came Emperor Diocletian in 301 AD. Desperate to control inflation, he issued the Edict on Maximum Prices. It fixed maximum prices for goods across the empire: food, wages, transport. The penalty for violating it? Death. But you can't legislate away inflation. Merchants withdrew goods from markets. Black markets emerged. Trade slowed. The financial system, once the backbone of Roman power, fractured. Now, here's the modern parallel. In 2008, global banks overextended credit. When trust collapsed, markets froze. Governments injected trillions to stabilize the system. Rome faced similar dynamics: credit expansion, asset bubbles, liquidity crises, state intervention. The difference? Rome couldn't print trust. And once citizens lost faith in the currency, the economic glue of the empire dissolved. By the 5th century, long-distance trade shrank dramatically. Banking networks faded. Europe would not see such financial sophistication again for nearly 1,000 years. So what can we learn from Rome, the world's first great banking civilization? 3 key takeaways. First, banking is older than we think. Cashless transfers, credit markets, and risk-based lending existed 2 millennia ago. Second, financial systems make empires possible. Rome's roads moved legions, but its banks moved capital. Third, Trust is everything. Once political manipulation and currency debasement destroyed trust, even the most powerful empire on Earth couldn't hold its economy together. The ruins of the Forum still stand. The Temple of Saturn still rises in broken columns. But the financial machine that once powered a continent? Gone. If you enjoyed this deep dive, watch our next video on how the Medici family reinvented banking in the Renaissance, the moment Europe rediscovered Rome's financial genius. And before you go, comment below, which ancient empire should we uncover next?